He didn't fire a shot, he didn't write a law, he didn't hold office. But in the eyes of the U.S. Senate, Charles E. Mitchell may have triggered the greatest economic collapse in modern history. It was February 1929. The Federal Reserve was growing nervous. Markets were overheating, stocks were rising 20% a month. Margin debt was exploding. Quietly, regulators urged restraint. But Mitchell, CEO of National City Bank, the most powerful banker on Wall Street, did the opposite. He expanded credit. He lowered rates. He injected over $25 million in margin lending, a staggering figure at the time. His message to investors: borrow more, fear less, the bull market will never end. Within 8 months it did. When the 1929 crash came, Mitchell's fingerprints were everywhere. The Senate would later call him the man who lit the fire. And in 1933, under oath, Mitchell admitted he defied every warning because the profits were too good to stop. But this isn't just a story about the past. In 2024, margin debt is rising again. Meme stocks are back, AI bubbles are inflating, and retail traders, many of them too young to remember 2008, are making the same mistake, mistaking leverage for intelligence. History doesn't repeat by accident. It repeats by design. Because once profit is tied to credit, and credit is tied to optimism, all it takes is one spark. Charles E. Mitchell provided it in 1929. The question now is, who's providing it today? This is the crash profit pattern. It starts with a boom, not from productivity, but from velocity. The system offers rapid, unearned profits. Traders flood in. Risk looks safe, and leverage becomes the main engine of return. Between 1927 and 1929, the Dow Jones Industrial Average tripled. But it wasn't corporate fundamentals that drove the rally. It was debt, specifically margin loans, money borrowed to buy stocks with just 10% down. And at the center of this explosion stood one man, Charles E. Mitchell. As CEO of National City Bank, the largest and most aggressive bank on Wall Street, Mitchell pioneered margin lending at industrial scale. He turned debt into adrenaline. Traders borrowed millions. Institutions borrowed billions. Entire portfolios were built on borrowed optimism. But here's what made it dangerous. The system rewarded Mitchell for the boom and left him untouched when the bust came. He made money on the rise and shifted the losses onto everyone else. When markets cracked, it was retail traders who got wiped, factories that got shut, banks that collapsed. National City survived, barely. But the damage had been done. That's the crash profit pattern. Incentivize speculation, amplify with leverage, exit before the collapse. It worked in 1929. It worked in 2000. It worked in 2008. And in 2024, it's working again. The mechanisms change. The faces change. But the architecture is the same. And Mitchell's playbook? It's not forgotten. It's been digitized. In early 1929, Charles E. Mitchell made a choice, one that would echo through history. The Federal Reserve was flashing warning signs. Margin debt had doubled in 2 years. Asset prices were unmoored from earnings. Quietly, central bankers urged lenders to tighten, to cool the euphoria, to slow the flow of easy credit. But Mitchell wasn't interested in restraint. He was chasing volume. As the head of National City Bank, what we now call Citigroup, Mitchell controlled the largest source of speculative capital on Wall Street. And when the Fed suggested raising rates to slow down the frenzy, Mitchell did the opposite. He publicly announced a $25 million injection into call loans, money specifically used to finance margin purchases. He refused to raise interest rates. He attacked the Fed in the press. His words: "I believe it is my duty to stand against fear." It worked. Traders piled in. Stocks surged. and National City's profits hit record highs. Behind the scenes, his bank was lending to everyone: retailers, brokers, insiders. IPOs were being launched weekly. Utilities and auto stocks rose 200–300%. Everyone was rich, on paper. But it wasn't capital formation, it wasn't investment, it was leverage, scaled up by one man's refusal to say no. By the summer of 1929, margin loans topped $3.5 billion, more than $60 billion in today's dollars. And nearly half of it came from just one institution, National City Bank. Mitchell had become the engine of speculation. He wasn't reckless by accident. He was aggressive by design. Because as long as prices rose and borrowers paid interest, the illusion would hold, until one pause, one shock, and everything would collapse. By mid-1929, Wall Street wasn't a marketplace, it was a slot machine, and Charles E. Mitchell owned the lever. The Dow had soared from 100 to 380 in just 5 years. Utility stocks were up 400%. Radios, autos, real estate, everything was rising, not because of earnings, but because credit was infinite. Margin accounts exploded. Retail clerks and shoe shiners were speculating. Office workers mortgaged homes to buy RCA and Bethlehem Steel. And National City Bank made it easy. Mitchell advertised margin loans in newspapers. Buy now, pay later, the headlines read. A new class of investor emerged, the leveraged optimist. The average down payment for stocks shrank to 10%. Risk was invisible. Only upside mattered. Media praised Mitchell as a visionary. The people's banker, they called him. His photo appeared beside stock tickers in Times Square. Brokers quoted his speeches like gospel. His confidence was infectious, but behind the euphoria, the insiders were exiting. J.P. Morgan's firm sold quietly. Andrew Mellon divested. Even John D. Rockefeller pulled back exposure. They knew what Mitchell refused to admit. The system was overextended. Every uptick was built on debt. Every new investor inflated the risk. By September, the market trembled. Volatility crept in. Still, Mitchell doubled down. Still, National City kept lending. Still, the crowd believed. Because in bubbles, the signal doesn't come from truth. It comes from price. And as long as price goes up, no one questions the structure, until the moment it doesn't. The unraveling began with a whisper, then became a roar. October 24th, 1929. Black Thursday. Markets opened with a thud. Prices fell. Volume surged. 12.9 million shares traded, the highest in Wall Street history. Brokers couldn't keep up. Margin calls went out. But most accounts were overleveraged. No cash, no coverage. Panic. Banks, including Mitchell's National City, scrambled to inject liquidity. A last-minute syndicate of financiers pledged $240 million to stabilize the market. It worked for 5 hours. 5 days later, it collapsed. October 29th, Black Tuesday. Volume hit 16.4 million shares. The Dow dropped 12% in a single day. Billions vanished. Leverage turned lethal. Every margin account was underwater. Forced selling triggered forced selling. It wasn't a correction. It was a liquidation spiral. Stocks with no fundamentals fell 80%. But so did the good ones. Banks failed. Credit evaporated. Within weeks, major firms were insolvent. Industrial production collapsed. Farms lost financing. Factories closed. And National City, the bank that fueled the boom, nearly didn't survive the bust. Its balance sheet was wrecked. Its reputation shattered. Charles E. Mitchell resigned in December. But the damage was done. By 1932, the Dow had fallen 89% from its peak. Unemployment soared past 25%. The entire financial system was scorched. And the cause, according to the Senate? Margin credit, unconstrained and directed by one man. Mitchell didn't just lose a fortune. He rewrote history. And in doing so, he handed future markets a dangerous blueprint. Because in finance, collapse isn't an accident. It's a design flaw, left ignored. In 1933, as America reeled from the Great Depression, the U.S. Senate convened a hearing that would change financial history. It wasn't just about accountability. It was about autopsy. The Pecora Commission was formed to investigate the root causes of the 1929 crash. And at the center of that investigation sat Charles E. Mitchell. Under oath, Mitchell admitted what many suspected. His bank had issued massive loans to insiders. It had underwritten and sold junk securities to the public, while offloading risk to shell entities. He had paid out dividends even as the bank hemorrhaged losses. All of it legal at the time, all of it corrosive. The testimony shocked the nation. Newspapers called it Wall Street's reckoning. Public outrage surged. Protesters surrounded banks. Senators demanded reform. And out of that fury came the Glass-Steagall Act of 1933, a law that separated commercial and investment banking for the next 66 years. Mitchell was fined over $1 million, a massive sum then. His reputation destroyed, his power gone. He faded from public life. But his blueprint survived. Because the system didn't erase the pattern, it just paused it. Wall Street learned something else from Mitchell, that you can profit massively before collapse. That gains are personal, but losses are socialized. That the real risk isn't being wrong, it's being early. And so speculation returned, first slowly, then permanently. What Pecora revealed was chilling, that the crash wasn't caused by chaos. It was caused by design, incentives that rewarded speed, leverage, and denial, even as the system cracked. And that design didn't die with Mitchell. It simply evolved. 90 years later, the names have changed, but the playbook hasn't. In 2021, U.S. margin debt hit $936 billion, the highest in recorded history. Meme stocks like GameStop, AMC, and Bed Bath & Beyond soared 400% to 1,500%. Not on earnings, but on emotion, leverage, and zero-commission platforms. Retail investors, many born after 2008, borrowed through Robinhood, Webull, and crypto exchanges. Call options exploded. TikTok influencers posted trades. The engine was margin. Again. And like Mitchell in 1929, modern players ignored the Fed. Even as Powell warned of overheating. Even as CPI passed 7%. Even as rates began to rise. Markets kept buying. Nvidia surged past 30x forward earnings. Tesla crossed 80x. AI tokens pumped 600% in weeks. The S&P 500 rose 114% from March 2020 to December 2021. The sharpest recovery ever recorded. And when the Fed finally did act, the bubble cracked base, but it didn't collapse. Because today's system is more elastic, for now. In 2023 and 2024, margin lending returned. Crypto rebounded, retail volume surged, AI stocks rallied. The logic is familiar. Cheap liquidity, exponential upside, leveraged bets, silence on risk. Investors aren't irrational, they're incentivized. The system still rewards acceleration over caution. And Mitchell's DNA is in it all. When he injected margin into 1929 markets, he wasn't breaking the system. He was using it as designed. The same is true now. The danger isn't stupidity, it's architecture. Because every cycle makes the pattern easier to repeat, and every trader who thinks this time is different is just another Charles Mitchell with a smartphone. Leverage isn't just risk, it's fuel. And margin, the right to borrow against assets, turns a normal market into a combustion engine. Here's how it works. When stock prices rise, brokerages allow more margin. That buying power is used to purchase more shares, pushing prices higher. Higher prices justify more margin. It's a reflexive loop, self-reinforcing, self-escalating. But it's a one-way street. Because when prices fall, that same loop goes in reverse. One drop triggers a margin call. That call forces a sale. That sale pushes prices lower, triggering the next call, and so on. In 1929, this margin spiral ignited the crash. Traders couldn't meet collateral calls. Brokers liquidated positions. Prices fell faster. Confidence collapsed. In 2008, the same happened with mortgage-backed securities. In 2021, Archegos imploded under $30 billion in margin. And today, the mechanism hasn't changed. Robinhood, TD Ameritrade, Interactive Brokers, all offer margin to retail. Big funds use swaps and leverage synthetics to hide exposure. Crypto exchanges offer up to 100x margin, with no circuit breakers. The system is optimized for acceleration, but blind to deceleration. And when volatility returns, margin becomes the fuse. Modern traders think they're safer, because apps show warnings or brokers post alerts. But software doesn't stop panic. It just updates it in real time. And here's the secret Charles Mitchell knew, and modern traders ignore. Margin isn't dangerous when markets fall. It's dangerous when markets pause. Because it's not the drop that destroys portfolios. It's the silence before the drop. When no one's selling, but everyone's leveraged. The crash profit pattern only needs one crack. Just one day of doubt. Then the cascade begins. And by the time the dashboard turns red, it's already too late. So how does it end? It doesn't take a crash. It only takes a stall. Every bubble has signals, and this one is no different. The pattern isn't in headlines, it's in data. Watch the margin debt curve. When it rises without corresponding earnings growth, the system is in stage 2. Watch options volume. When calls outpace puts 10 to 1, risk appetite has drowned caution. Watch credit spreads. When junk bonds yield like treasuries, the market no longer prices fear. Watch retail inflows. When cash floods into zero-profit stocks, narrative has overtaken analysis. In 1929, the indicators were buried in ticker tapes. In 2024, they're in your phone, and right now, the flashing lights are everywhere. AI companies with no product and 10x valuations. Crypto projects rising 600% in a month. Social trading forums treating margin as a badge of honor. Young investors YOLOing entire paychecks into options on hype. It's the same energy Mitchell amplified, just digital now. Meanwhile, the Fed is shifting. Rate cuts are coming, and markets are celebrating. But here's the irony. That's when the real risk begins. Easier money doesn't just heal, it fuels. And the next phase, stage 3, is where the leverage finally outruns the collateral. The system doesn't break when rates are high. It breaks when everyone assumes they'll keep falling. And right now, that assumption is everywhere. Charles E. Mitchell never saw himself as a villain, just as a facilitator, a profit maximizer, a man who gave the market what it wanted. That's why this next break will look the same, because it won't be caused by evil, just incentives, working perfectly. Charles E. Mitchell wasn't punished for causing the crash. He was punished for making it visible. He profited on the way up. He protected his bank. He leveraged the system legally, openly, and boldly. And when it all fell apart, the public didn't blame the system. They blamed the spark. But the fire didn't start with Mitchell. It started with architecture, with margin laws that didn't cap risk, with a market that mistook leverage for innovation, with a public that confused credit-fueled rallies for prosperity. And today, every piece of that puzzle is back. Margin is higher than ever. Retail risk is surging. Regulatory bodies are reactive, not proactive. The average investor doesn't understand the system. And the system rewards that ignorance. So here's the warning. If you're profiting in this market, understand what's powering it. If you're using leverage, know what it owes, not what it earns. And if you think we're smarter than 1929, you haven't studied 1929. Because Mitchell's pattern wasn't a mistake, it was a blueprint. And right now, it's being followed. This video wasn't about a man. It was about a mechanism. One that prints money before collapse. One that flatters investors before it ruins them. It worked in 1929, it worked in 2000, it worked in 2008. And if unchecked, it will work again in 2026. Profit is not the signal, leverage is not the solution, and speed is not safety. Remember Mitchell, not as history, but as prophecy.